An earnings trading strategy for consistent results. This strategy is perfect for beginners. And also if you're already a seasoned trader, I'm sure that you would love to add this to your strategies. We're going to look through many stocks. An example is QUBT, which I sent out as a recommendation in my newsletter. You can see it did about 96% in just a few days. QBTS, this is also recent, just this May 2025, 125% in a few days. We shall also go through PRCH. We can see that on the first earnings, it did about 50%. Then I sent out an alert for people in a newsletter, 41% in just 2 days. Then I really love SEZL. This one did about 100% in just about 3 to 5 weeks. Then this one was also very sweet, participated in this one as well, got about a maximum of 80% in just a few weeks. These were recommendations that were sent out in the Profit Punch newsletter for people to buy, and we did make a huge profit. So I wanted to make this video because these are not studies of past trades. These are actually trades recommended before they happened. People made a lot of money from them because a lot of stock market channels do back testing, but here we are learning from the results and from what we got. If you're enjoying this video and want to build financial freedom using the stock market, I put together a free guide called 10 chart patterns that make money. It's based on the exact system that we use at Profit Punch, a financial newsletter and educational hub that sends you A+ stock setups where we tell you exactly when to buy and sell, and also will teach you stock trading from the ground up. These are the same patterns that our members use to catch moves like SMCI 250%, NVDA 200%, AppLovin 350%. The guide is short, visual, and beginner friendly. Just click the link in the description or pinned comment to grab your free copy. Now back to the video. In this video, you're going to learn why earning gaps offer huge potential. We're going to see the criteria for finding the winning stocks. You're going to learn about super growth stocks, what makes a very strong earnings report. You're going to learn how to buy and sell these earnings gaps. Where should you put your stop loss, risk management, profit targets, and what are special conditions where you ignore those profit targets and switch up. That's going to be very interesting. Of course, we'll look through the deadly mistakes to avoid. I learned these mistakes on my own because I was doing research on this for so many years. So I've gone through all of those mistakes. Where I'm going to show you tools that you can use to scan and find these plays every day when they happen. And then, of course, we'll go through the real trade examples and case studies, because this picture that I showed you, they're nice to look at, but for each of these, there's a methodology behind each one of these trades. And in the newsletter, when I'm recommending them to you, I normally explain why and what has to be done. So if you want that service, don't forget to sign up for the newsletter, Profit Punch newsletter, but also this video, you're going to learn everything for free, and you can still do it on your own. The newsletter is only for those that want me to just do it for them. I just tell them, hey, this is when to buy. And if you're not able to make your money back from the trades, then of course you get a refund, because these things are supposed to work. So why do stocks normally gap up? Now, when I was trying to study gap ups, I went through so many studies. I went through biotech drug results. I was very excited about these. But the problem is that I couldn't find a consistent pattern. Some stocks were going up a lot, but some would gap up and crash. So I failed to achieve consistent results. I looked through mergers and acquisitions. These were good, but the problem with mergers is that you're always too late to the trade. If Twitter is being bought at $20 per share, by the time the news comes out, you're late. Then there are deals on contracts. I also failed to get consistent results here, but that is because maybe I did not understand the deals very well, and it's also very hard to go through a lot of the news and try to study the deals. Because sometimes a trading strategy is not difficult in itself, but getting the criteria correct for the trade can be difficult, and in that way you're not succeed. But when I studied earnings news, I found a repeatable, profitable strategy. I did about 30 trades. Each of them I was risking about $30. And by the end of all of those trades, I actually made a $1,000 profit. And then I was like, okay, this thing works. Now we can try to scale up to get bigger results. I'm not going to be one of those videos that's going to go around and hide everything from you. You're going to get everything from the start. The criteria for success, and this is all you need to know, is that you want to have a bullish day in the market. That is because 75% of stocks follow the market. Of course, when the market is going down, the gap ups might manage to go up, but since the odds are against you, it's just not good out there, right? So basically what I'm saying is if you try and find a wife or a husband, there are some places where you don't try to look for such people because the odds are against you. So don't go into a strip club in Miami. Of course, there might be some people who are going to be nice and husband and wife material there, but on average, the odds are against you. And that's the same thing for the stock market. Sometimes the setup is perfect, but the conditions are not right. That's what I mean by bullish days. The stock must be in a bullish industry. I realize that sometimes even if earnings were great, if a stock is not from a bullish industry, it was just a waste of your time because 80% of earnings winners, the ones that I studied, were from bullish industries. Then the stock needs a catalyst. The catalyst can either be a super growth stock or a stock that has a super earnings report. You like to see hundreds of percentages in EPS or sales surprise. I'm going to show you how to read that on the chart. It's very easy. The stock has to have a gap up. The gap up should be at least 7%. For very big companies like NVDA, even if it does something like 5%, I mean, it's a $3 trillion company, that is still a very substantial move. But on average, you want at least 7%. And one of the most important and the lastly is that it must be coming out of a big base or a consolidation. The stock must be dormant for at least 4 to 6 weeks, because if it has already moved, then it's not a surprise and this strategy might not work. Stop loss guidelines, because making money is nice, but the only way to make money in the stock market is by handling your losses. In the stock market, if you know how to handle your losses, you're going to make money, no questions asked. I realize that most companies never went below 0.8 R, and 1 R is 1.5 times the average true range of the last 14 days. Smaller companies, it's better to use a full 1 hour stop loss. And an alternative approach is that since 80% of winners don't go under 0.7 risks, you can also use 0.7 risks as your stop and then re-enter as needed. And then how can you buy and sell these things? You can either buy 75% at the open and then buy the rest when it has moved above the 5-minute highs. That's one type. But actually, from my experience, I normally just buy everything at once and I accept the loss once it comes, because buying in halves was making it difficult for me. So I decided once it has a good setup, I just buy everything at market open. And if I'm stopped out, okay, I can always get in again. And then how to sell. There are two ways of selling. You can either use a profit target, which I'm going to show you, or you can ride the stock and wait for it to close under the 10 EMA. And this is normally under special conditions. And here are conservative profit projections, and this come from studying hundreds and hundreds of stocks. Normally in these earnings gap ups, you're going to find 3 scenarios. The best scenario is when it's coming out of a big base, and this base is greater or equal to 10 weeks. This one you can aim for 5 risks to 7 risks. Then the second situation is that it has jumped out of a big base, but the earnings come in the middle of that move when it has already jumped out of the consolidation. You can aim for 4 to 5 risks. Then it could also be jumping out of a small base. A small base is something which has been sitting for less than 10 weeks. Normally, I just aim for 3 risks on this one. The disclaimer is that you can never know, because one of the biggest winners actually was Root in February 2024. This one, it had 75 risks. For every dollar you risked, you got $75 back. If you were willing to lose $200, you got paid $15,000 by the end of the trade. Now, of course, such trades are not that common, but you get the gist. Then there are special selling conditions. For these special selling conditions, we use a 10-day exponential moving average as a selling guide. You wait for it to close under the 10-day, sell 50%. Once it moves below that, then you sell the rest. Because sometimes it can close under, but then it recovers the next day. So then you would have to buy back. These are special conditions because we don't know how far they can move. Because you saw Root moved 75 risks. Many of them will move like 20 risks, which are very, very huge moves, as you're going to see. So the best thing you can do for yourself is just sell 30% of the position when it's about 10 risks from the open of the gap up. The reason I say this is because I realize that about 10 risks, these big moves, they start to get wobbly. Anyway, so what are these special conditions? Normally when we have an EPS or sales surprise, which is greater than 100%, and then we have a big base breakout, that's a good one. Then the second one is if both of them have at least 40% and you have a big breakout, that's also a nice special condition. The third one is if the stock market has come from a deep correction, that means the stocks have been depressed down and they're compressed down and they just want to jump up. And this company is a super growth stock, and then you have a big base breakout in earnings, then you can use the 10 EMA. So here's an example of a stock coming out of a big base. So we see that AppLovin sat for about 5 months, releases good earnings, and then you can see jumps out to about $50, runs up to $90, right? This is an example of a gap up in the middle of the move. This one had sat down for a long time from about September. Here it forms something called a virtual contraction pattern. and then it jumps out of that big base. You see this very big consolidation here. The move is not yet done, and then the earnings gap is in the middle of this move, which is already big. So this is what I meant, a gap up in the middle of a big move. Understanding these strategies is great, but it would even be better if you understand the whole cycle of the market, because when you can understand the whole market cycle, which I teach in my other videos in the resource hub of the newsletter, then you can understand where you are in the market. By knowing where you are, you can start to act accordingly, because the earnings gap up is just a cog in a big system. If you understand the big system, then you can always tweak your earnings move to even do better results for you. So what are super growth stocks? These are stocks that are growing like crazy. Ideally, you want something which also has hype behind it, like AI, quantum computing, things that people don't understand, but they seem hot and cool. Must have one of the two traits: return on equity, EPS growth. It must have that. Revenue growth, that's what you have to look for as well. So it's good to know what super growth stocks are, but you don't need to be looking for this the whole time. So what I normally do is that I just put it on the chart, and then I can always know. So on my chart, I have a dual view. I have a weekly chart on the side, and then I have the daily chart. I looked at 2 time frames at the same time, and I always overlay the earnings table. This is an example of a super growth stock. You can see the earnings per share growth. It's very good. It's very huge, because remember, for earnings per share growth, we wanted at least 30% over the last 4 quarters. We definitely have that. Return on equity, we want something at least 15%. We definitely have that. This is Powell Industries. This was also a super growth stock from about 2023 to 2024. You can see it went from $20 to about $200. So it went up times 10, and it had several earnings moves in the middle of all of this. So this is not a super growth stock. This is AMR. It's a call stock. It still moved, but it didn't move because it was a super growth stock. This is a call mining stock. So it doesn't have the criteria that we're looking for. And what is a strong earnings report? This is an earnings report that shocks everyone, and the company has abnormal growth. So people are expecting the company to do this, and then it just shocks them and does something totally different. So we're trying to find these stocks that are shocking everybody. So what you like to look for is anything which has over 100% earnings per share growth or revenue growth. That's amazing, right? I'm going to show you a stock called SEGA. It had a 9,000% EPS growth. Revenue had grown 900%. So you're looking for 2 things. You can either look for good earnings per share growth and revenue growth for that particular report, or you can see how much people have been surprised. So either what the company has done, the actual growth, or how much people have been surprised. So for surprises, we also like an earnings per share or revenue surprise of over 100% for that report. Or if both of them are at least over 40%, that's also magnificent. So here you can see SEGA. It was suffering for a long time, and then you can see that the first earnings here, revenue grew 900%, EPS grew 9,000%. Then you can see that the thing just moved 66% in just 1 month. Then I have the 10 EMA, and I show you where to sell. So it jumped up from about $6, went all the way to about $10. Bullish industry. What is a bullish industry? All stocks are part of an industry. So you want to make sure that that industry is in an uptrend. TC2000 is the best software for this, and I know a lot of people might not have it. That's why I offer the newsletter, so that I just give you these stocks ready for you to pick. So like NVDA is in the semiconductor industry, so you want to make sure that semiconductors are generally trending up. You just want to look at the industry chart or the ETF for that sector, and then make sure it's above the 20-day moving average and it's trending up. It's as simple as that. So you see here, Powell Industries, we can see that it's in producer manufacturing and electrical products. It's a super growth stocks. Then in TC2000 here, I overlay both the industry chart, so you can see it's trending up. This is one of the biggest earning moves I was telling you about. You can see it went from $5 to about $80. The industry was bullish, and those earnings, that earnings trade came in the middle of this all bullishness. So the environment was good and ripe for the stock to act right. How do you scan for these earnings gaps? I'm going to show you the examples later on, but I want to give you everything that you need. And of course, these slides, if you want them, they're going to be on the resources page of Profit Punch. So just scan for stocks that have gapped up in the morning and then check if they have earnings. As simple as that. I normally use a TradingView scanner, or you can use a bar chart scanner, but I use TradingView. Of course, like I said, just sign up for the newsletter. I'll be emailing you every morning when I see these things happening. TradingView, I just do this. It's very easy. You can copy my scanner there. Bar chart already has an automatic scanner that tells you the gap ups. How much should you risk? I normally will risk about 0.3 to 0.5% of my account. If it's a very good play, I could even risk 1% of my account. Like I said, where you're buying conservatively because you're likely to be stopped out and there are many failing trades. But on average, you're still going to win, because if you're going to get 10 risks back, then that one win can handle your 10 next trades. But also with more experience, then you're likely to pick out the best of the best stocks, and then you're likely to fail less. And then what are the deadly mistakes you want to avoid for this strategy? Make sure the stock is coming from a big consolidation. If the stock is not coming from a big consolidation, then there's no surprise it's going to crash. Many times, stocks gap up and reverse down on earnings. Sometimes it will gap up on the day and then it crashes, but then it recovers the next day. So don't give up. As soon as it goes down, keep an alert. If it comes back, it's going to be very good. I'm going to show you an example of when that happened. Avoid trading in pre-market or after-market hours. This is not a very good time for this strategy. It's tempting, but since there are not enough participants, it's hard to place stop orders. If you're stopped, it's very hard to be filled during that time, and then it's just acting weird. And also avoid illiquid stocks. Illiquid stocks will make you cry. Make sure that the stocks normally have at least 1 million shares. I normally look for at least $30 million has been traded in the stock for the past week. Some earnings will be slow on the earnings day, but then gap up and be active on the next day. So be careful. Sometimes it doesn't look like it's moving, but then it moves. This is a summary. Like I said, you want a bullish market day, bullish industry, you want a gap up, big base, great earnings report. Easy. Now let's go into our case studies. The first one is QUBT. Okay, so why is QUBT a very good stock? So here you can see that QUBT went up about 100% in just a few days. So the first thing is that you can see QUBT is coming from this nice cup and handle, right? This is a cup and handle. That's what I was saying. You have to know the general market structure. The market was also coming from a dip correction. And then we can see it forming this, it's compressing over time, And then at the same time, it's also in a very strong industry because all the stocks in quantum computing were moving. It also has a strong IBD relative strength here, which is a custom value to see how strong a stock is. Whenever this number is above 60, the stock is really strong. So this one had everything. And I just told people to buy. I'm still holding it. I'm going to wait for this one to close under the 20-day exponential moving average because it's jumping out of a big base, good industry. So I wasn't treating it like an earnings trade. I actually just treated it like a normal breakout. Then the next one in our agenda is QBTS. So QBTS is also, as you can see, it is also quantum computing. So something is going on in the quantum computing stocks. So you see this nice base here. It drops 60%, then the next drop is about 45%, and forms again a nice tight thing of about 17%. So this is something called a virtual contraction pattern. So it keeps contracting. And then finally, it loses its mind and then breaks out. So you see earnings and earnings revenue surprise were all above 40, which is what we are looking for. And then it moved about 125% in a few days. You remember when I told you at 10R for the special situations, because this is one of the special situations, sell about 30% of the position. Then here you'd have sold about 30%. It would have come down, closed on the 10-day exponential moving average, and then you'd be out. But you see, by the time it comes back to close under the 10-day, your profits have evaporated by about 30%. That's why it's good to take off as it goes up for such moves. You can see that since the stock was small, it was a little bit volatile and it almost stopped us out, but it didn't. And this is what I was saying. For big companies, you can use 0.8 risks as your stop loss level. For these smaller companies, you want to use the whole 1 hour as your stop loss. And what does 1 hour stand for? 1 hour is 1.5 times of the average true range of the last 14 days. And to make it easy for me, because I don't like to think, I just put the value here. So I have the actual value and I have the percentage on my chart. And I also have this indicator here that shows me for the particular day what are the risks. So on this 7th May, it's about $1. The black value is the 1.5 average true range. This one is the average true range. Then this is the IBD relative strength for that particular day. So here we know just $1. You can see the risk was 1.07. So that's how we create these risks. I hope you're learning. Next one is PRCH. This one was nice. This one had some good earnings, very easy. You can see here 300% surprise. This one I said wait for it to close under the 10-day, but unfortunately, by the time it closed under the 10-day, your profits had halved. That's why this second time I was like, this company cannot be trusted, so just sell early. But yes, this was also a very good trade. Next one is SEZL. Now we're getting into the really good stuff. Now this one was very successful. Why? It's coming out of a big base. Market is coming out of a correction. We just buy here. You can see the risk is 5.95. Where do we get that value from? Look at the previous day, 5.95 up there. Look at this value here. For the previous day, there's 5.95. That's what we risk. See that? Just buy at the market open, easy. And it's even still up. I don't know how long it's going to keep going, but you can see what it's doing. Then the one that I was stopped at last Friday is this one. This was a recommendation, but let's see what the actual trade did. Now you see how close it was. You see when you go to market open, you just buy on market open. Where do we get that value? 9.35 from the previous day. Actually, I think it's just supposed to be 9. Okay, so you can see we were not stopped out either, right? So just buy at market open. It was acting a little bit iffy. Decided to move. You also got 11 risks. You reach up to a maximum of 12 risks. Which remember, I said when you reach 10 risks, sell 30% of your position and then wait to see if it closes under the 10-day exponential moving average. So that was a very successful trade. I remember this one, I risked about $50. I got paid about $600. So that was, I mean, yeah, it kind of makes sense. $50, 10, yeah. I think I risked more than 50 because I don't think I'd have gotten 600. So maybe I risked $60 to get $600. But you can see how easy it was. Next one, Dave, we've gone through that. Then CLS, now this is one of those special situations. Now this is a super growth stock, so I'll show you an example. This is the earnings trade. I told you always look at both sides. So by the time these earnings were released, this was a super growth stock. As you can see here, return on equity, it has at least 2 out of the 3 conditions we're looking for. Then we can see it forms a very nice base here. So let's just study the base. Base 1, 16 weeks, it has been sitting down for a very long time. So from around, I would even consider from around here. But anyway, from here to here is about 16 weeks. This looks like a double bottom, a bit confusing, but then it comes up here and forms this nice handle, jumps in earnings. What do we do? For this one, the market was recovering from a correction. That's one thing. Super growth stock, earnings. So you can either play it as an earnings trade. I think you'd have exited around here. But since the market was coming out of a big correction and it's jumping out of a big base, you can treat it as a long-term breakout trade. So there I would use the 20-day exponential moving average as a sell guide. So it's no longer just, and so in my head, it's no longer just an earnings trade. So this is where I was saying that these are special situations. If you understand the bigger picture of things, then you can adjust accordingly. So here, I think the stock went up for a maximum of about 105%. And then I think you could have risk. The risk was around, let me see, the previous day had a 3.37. So let's see what that is in percentages, 3.37. You'd have risked 5% to make 100%. So 1 to 20. So if you risk $100, you get $2,000 back for this trade. Let's go on to the next one. AGX, jumping out of a big base. Market is coming out of a big correction as well. It's a super growth stock. The earnings report doesn't have huge surprises, but since the stock is already strong in itself, just like CLS, also here there was no big surprise. It just had good earnings. Everybody was not surprised anymore. At the same time, this is a strong company. It's jumping out of a big base. Then in that case, you can use the 10-day or the 20-day EMA. So here, if you use the 10-day, the maximum profit you could have reached was about 20 times your risks back, right? Because risk was $3.88. Maximum profit was $76. And then if you use a 10-day, you probably exited here for about 15 times your money back. So if you risk $100, you get paid $1,500. If you use the 20-day exponential moving average, you probably exited around here. So you get about 14 times. So it's very similar. And I hope you can see how these trades have worked. That was all. Thank you for your time. If you like this video, please hit the like button. Sign up for the newsletter.